This is Yahoo Finance's Morning Brief. I'm Julie Hyman. That is Miles Udland across the table from me, and I am back.
You're back.
From Houston, Texas, which is the place in the United States right now that you do not want to be if you are trying to fly out of a George Bush airport in
Can we just start with this?
Houston, Texas.
Can we do a little travelogue segment? A little
Sure.
bit. Can I hear about your travails?
Sure. So flying down there was no problem, right? But famously, as anyone who's been watching anything knows, this airport in Houston is one of the worst in the country right now in terms of the lines for TSA, for whatever reason. And it seems like maybe these folks are overworked and underpaid at this particular airport. Especially, I saw a figure that 40% of the TSA agents there have called out, which is a much higher rate than other airports. And it's a really busy airport. So my plan was on Tuesday to fly out of there at 5 p.m. I arrived at the airport at about 12:45. Okay. Got dropped off. There's a long line outside, snaking, in and out. But the line actually started downstairs. So
you're going to go inside, outside, inside.
Correct.
And how's the weather? Or is it hot there?
It was hot. It was hot. Out of the sun at least.
Okay.
Out of the sun, so not that uncomfortable. Not that uncomfortable.
Yep.
So I go inside, and it was, it felt very institutional. There were a lot of sort of tape. Anyway, so I got in the line and I thought.
What color was the tape? Was it yellow?
It was yellow
black?
tape,
Okay,
yellow tape,
that's good.
and various
cones?
stanchions
Were there
going along.
cones here?
The people, there was sort of a sense.
Stanchions, yes.
There was sort of a sense of camaraderie, among the people who were
no one showed up
there.
at the airport thinking this is going to be awesome.
Right, exactly.
Yeah, okay.
So everyone, the guy in front of me in line said, "You look familiar," and somehow, I guess he's thank you, sir, if you're watching Yahoo Finance.
What a flex. What a flex by you.
But quickly after I was in the line for a little bit, although it was moving, I realized I might not make my plane. And a colleague of ours, our cameraman, was planning to rent a car, drive to Austin, and fly out of Austin. And this was actually a common tactic by people I spoke to.
A 2-hour drive, 3-hour drive?
2.5, 3-hour drive.
Okay.
So I decided to bail, booked the flight out of Austin, got out of line, took the shuttle to the rental car place. But when we got to the rental car place, there were no cars available. He had booked a car, but there were no cars available. And so we ended up driving to the other airport and renting a car there.
Yeah.
And then driving to Austin, and then coming home.
Okay.
So it was a long day.
Great. And you were there for?
I was there for CERAWeek. This is the important part of the travelogue. CERAWeek, which is this big oil and gas conference put on by S&P Global, and obviously it was an interesting time to be having this conference.
Yeah.
It was kicked off, the whole week was kicked off by Chris Wright, the energy secretary, who sort of said, the Iran war will be a short-term disruption to oil markets. His comments were followed by those of Mike Wirth, who's the CEO of Chevron, who basically said, not in so many words, markets aren't correctly pricing in what's going on the ground in terms of and
that implication is
supply.
That prices are too low. Yes?
Prices are too low, especially out the curve, is what he seemed to be talking about. And in fact, if you look there, the Dallas Fed comes out with its survey.
Yes.
And there are a lot
Monthly.
of oil and gas investors, oil and gas executives, who are reflected in that survey. And if you look at their price forecasts, they're actually not that high. The price expected in 6 months, according to 116 oil and gas firms that answered this, the average was 78, but the distribution is quite high, up into the $150 range.
Yeah.
And there were definitely folks I talked to there who said, if this continues for another month, we're looking at potentially $200 a barrel.
So these industry conferences are always interesting because it feels like the general setup, and this is maybe a meta comment here, right? Whether it's a leveraged loan conference or a software conference, one at Dreamforce, one of these things, the conceit is basically, I think, everyone shows up and talks about why the market is not understanding the opportunity in our business, often to the positive side. But it sounds like the view here was that everyone from the oil industry showed up. And by the way, the whole reason that we wanted to go in the first place was to talk to all these power companies, energy companies about the AI trade.
Yes.
And then the Iran war kicks off 3 weeks before the conference. So now you have this overhang. And so it felt like everyone gathered to not say everything's everything's better in our industry than the market believes, it sounds like everything's worse or is going to get worse, or my view as an operator is the path to energy prices, let's say, just going higher. The supply crunch is getting tighter while the market sits there and has oil around $100 a barrel, which we just don't think reflects the problems that we're seeing in the ground.
That's right. I think that's the overall view of what we heard. I mean, that said, a lot of the oil and gas executives were, reluctant to go too hard, too publicly on that.
Yeah.
There were a lot of sort of side conversations that were more to that effect.
Another reason to go to the conference.
Yes, and the other thing is that it doesn't feel like, even with these higher prices, that production is going to increase, right? We're not necessarily going to see capex increasing. Mike Wirth, during that same commentary, said he sees their production, at least Chevron's production, at least in the Permian Basin, plateauing, right? So, even if they are concerned about the higher prices, the effect on demand, for example, they're not necessarily seeing those higher prices as sustained enough that they want to go out on a limb and spend more on drilling, at least not at this point in time. So that was really interesting. I mean, the other piece of all of this, and one of the other big topics of the conference, more on the power side, is natural gas, right? That this is a boon potentially to the U.S. natural gas industry because we export liquefied natural gas, and there are now more places in the world that want it, and our natural gas is cheaper than it is in Europe right now, for example. The problem with natural gas, I mean, there's a lot of supply constraints. If you wanted to order a gas turbine today, you're not getting it for years and years and years. And the other thing is sort of pipeline constraints. Like if you want to get your liquefied natural gas to those export terminals on the Gulf Coast, they're at pretty close to capacity. And so there's one of the other, you'll love this. You love this kind of discussion. A lot of talk about permitting reform at the conferences too. That's been a consistent, but obviously this administration is more amenable to that type of permitting reform than the last administration.
So just to wrap up the CERAWeek download, on the actual AI front, and that actually gets to the natural gas point, because a lot of these new data centers, all right, the easiest way we can get power, if it's a bring your own power situation, is you can try to get one of these turbines in a shorter order, et cetera, et cetera. There were still discussions about how AI has changed the industry. What was the readout there? Is everyone still kind of like, this is going to be great?
Yes.
Okay.
In a word.
In a word, yes.
Yes.
Okay.
A couple of takeaways from that right now. Natural gas in the past was always talked about the bridge fuel to renewables. That discussion has kind of gone away. If anything, it's kind of flipped. Right now, solar and wind are actually cheaper than any other. If you wanted to start a project today and get it quickly, that is the quickest and cheapest way to get it right now. And then that's almost a bridge to then getting your natural gas, which is seen as, it's less intermittent as a source of energy. So that was something that was talked about as well. But yeah, I did not hear any kind of concern about demand from data centers. Power is still seen as the big bottleneck. And so these companies are really focused on trying to solve that bottleneck.
Yep. All right. Let's talk about those data centers. Let's talk about AI. Number of developments this week, some of which we've gotten to, some of which we haven't. Let's just kind of take these in. Let's start with OpenAI, because they've had an interesting week. Latest headline coming from the Financial Times this morning, they're going to shut down their erotic chatbot is what they called it.
Yes.
Adult focused.
I think it was in development, and they decided.
Yes. Well, it had been paused, and now it's being shelved indefinitely. And this comes as OpenAI is trying to get rid of side quests, I believe is the internal lingo they called. 2 days ago, while you were in transit, probably on the road between Houston and Austin, the company came out and shut down its CERAWeek video creation app. So let's just do the OpenAI piece, which I think is interesting in a couple of contexts. The first being, this is like when you have really big private companies, you get a lot of reporting on essentially their product roadmap, which is not something that generally becomes a feature of the business press. It is very reminiscent of Uber to me, in that a lot of the Uber controversies, like the famous one, the gray ball controversy about basically taking Ubers that, whatever, it doesn't matter what happened there. I don't want to get that one quite wrong. There's books about it, movies, etc. HBO movie, Kyle Chandler was in it. Played Bill Gurley. It has a feel of the Uber timeline, in that we're hearing a lot about OpenAI's private, product roadmap.
Yes.
Because it's an $840 billion company that's probably going to come public later this year and doesn't exactly feel like it has, let's say, the public's wind at its back right now.
Yeah, and you and I were talking about this Substack that Noah Smith put out, where he talked about that AI has really done a bad job of selling itself, because you've had all these AI executives say, well, there's a non-zero chance that AI could eradicate humanity at some point. There's a 5 to 25% chance, depending on who you listen to. But ultimately, what he says is that, these companies have kind of, then why do AI in the first place? Well, these companies, according to him, have done AI because their thinking is, well, I'm more responsible than the other guy. If everybody, right. I have to do it before somebody else does who's not going to be as responsible around it.
Is this the prisoner's dilemma? Is that what they call this one?
There was he gave a name to it. I don't recall what
I'll try to find what
the name was.
Yeah.
And so this kind of speaks to what we're talking about with OpenAI making this decision. Except in this case, it wasn't necessarily like them having this come to Jesus moment or whatever and wanting to do something moral. It was probably just public pushback, and they decided that it wasn't a good idea for various reasons. They weren't ready to come out with this kind of a product. But I think it speaks to this very uneasy relationship right now between tech and the public, and the question around, are these guys going to be regulated by Congress or whomever? Maybe not, but maybe is the public pushback going to be enough that they're going to scrap or to sort of curb some of their worst impulses? I don't know.
Yeah, so I guess the thing that reminded me about Uber, and there was a dust up on Twitter, Emil Michael, who's now in the Trump administration, he brought the Uber thing came back up again, where he was ousted as part of the Uber leadership, him and Travis Kalanick, among others, by their investors, by Benchmark. He's still pissed about it. And he's like, I'll never forgive them for it. So the FT here says OpenAI shelves the plans for the erotic chatbot following concerns from staff and investors. So the investors' point is interesting here because it's framed in a way that the investors care about the erotic chatbot, like on the face of the content of the chatbot. But I think they really only care about, will this be bad for the company in the ways that you outlined? Does it invite regulation? Does it invite even more public scrutiny? AKA, does it hurt the value of my investment? I don't think they really care about the product you're releasing per se. They just care about how much that product helps the valuation, and if it doesn't, then get it out of here.
I mean, you could easily envision a future, you've already had lawsuits that we've talked about before about people who have committed suicide after they've been in conversation with various chatbots. You could easily imagine a situation in which someone's spouse, for example, gets involved with an AI chatbot, divorces them, whatever, and then that invites a lawsuit of some kind. Oh, you've designed this chatbot to be too engaging or whatever. And this brings me to the ruling that we just got on social media, I think. Or am I going too soon? You want to?
Okay. I think it ties in, but I think these are slightly different in this sense. So that's an individual. Now, these were individual lawsuits that got to Meta and whatever, and we'll get to that in a second. But I don't think a company is scared of a lawsuit. They're scared of lawsuits that invite lawmakers to get interested. Companies get sued all the time and have been sued and will be sued, and that's fine. But how much does it create a situation where you now have larger regulatory bodies, entire swaths of the population now against your service? The thing with Uber is that they had plenty of lawsuits and still face plenty of lawsuits, but the public perception problem has kind of gone away the last several years. I mean, you don't hear about it anymore. You know why? Because it's a fantastic service. And even though there's things about it, like sometimes you get Uber Eats and you're like, man, I'm not really sure this is, this is great for humanity in some way. Like maybe you just feel bad about yourself for not cooking your own dinner instead. But it's an amazing product. So I think the investor part of it is like, hey, if you have an amazing product here, can we not create these distractions? Because distractions are going to be a persistent part, legal distractions of any company's arc. The question is, how much do they affect the business? So, yesterday and the previous day, we have the two rulings. The first is Meta only. Yesterday, we have Meta and YouTube. Companies found essentially not protecting children on their platform. Nominal fine being paid by Meta will have to be paid by Meta in the New Mexico ruling, which came out on Tuesday. I believe Penalties, remedies are not 100% clear, is my understanding yet, in the Los Angeles case that came across yesterday.
Well, I think the numbers I saw
Damages.
were about $4.2 million in compensatory, and punitive damages for Meta, 1.8 million for YouTube. So those were the numbers I saw. They're undoubtedly going to appeal those decisions.
Million or billion?
Million.
All right, so again, we're talking literal chump change for these companies.
So now, I don't know if you saw about this. The lawyer for the plaintiff had this whole bit where he had a big thing of M&Ms.
Okay.
And he said this represents the profit. And then he took out an M&M and he said this is what you're going to impose against them. It's an M&M. It has no effect on them whatsoever.
All right. So the financial penalties for companies of this scale, essentially impossible to come up with ones that really, they feel enough.
Yes.
But this has brought up multiple publications, and let's talk about it. The big tobacco moment.
Yes.
I'm not as sold on this being that kind of case, but make it for me.
I don't think it's necessarily this. Well, and I'll tell you why.
Yeah,
I think the other thing I've seen a lot of commentary on is that the media has, the public has already turned against social media, right? They still use it.
Right.
They still use it
no one's
a lot.
Happy about it.
But they're not. But the sentiment towards social media is very negative.
TikTok creators have Substacks talking about how they hate being on TikTok. Yeah.
So it feels like, the tobacco moment was really a broad cultural moment. It's not as though those damages ruined those businesses. It's that people decided not to smoke anymore. That it was bad for you. People already know that social media is bad for you. This court decision didn't tell us anything we didn't already know, effectively, right? So that's why I would argue it's not necessarily the big tobacco moment. Because I think marginally people will stop using these services. I still have accounts on these services. I don't actively go on them anymore. I don't know if I'm still counted as a monthly active user. But I don't know that there will be a wave. The Jonathan Haidts of the world who have argued against children being on these services at all. I don't know that has been powerful. I mean, you can look at the numbers. It hasn't been powerful enough to really eat into these companies' revenue. And YouTube is the biggest streamer now, so clearly it's still doing fine.
Yeah, I mean,
it would say it's not social media. It said in the trial it's not social media, but.
Well, now it's got shorts.
Right.
Which I find myself getting sucked into because now I took Instagram off my phone,
but
I'm still logged in. So if someone sends me a reel, like at work on Slack, I can see it on my desktop, but I'm not going on my phone.
So you still get notifications?
Well, I don't have the app anymore, so I don't get notifications.
Oh, okay. So how do you know someone has sent it to you?
Oh, like if they Slack me a link. You can send a link to an Instagram post or whatever.
Okay.
And it's the same deal with TikTok, where I have an account, but I don't have the app on my phone. My wife sends me TikToks all the time via text, and I can get it on the computer where I'm logged in. So I'm probably an active user for both.
You still count, yeah.
Yeah, but it's still like this, it's a very conscious thing though, of like, how do you arrange your digital life? And yeah, I think that, the question for social media companies is basically like how much more pain. I mean, you've gone through, if you're Facebook, you've gone through Cambridge Analytica. You've gone through taking Trump off the platform, then having him get upset, then bringing him back on the platform, now having Mark Zuckerberg be a friend of Trump.
Yeah.
You've gone through like many political, you've had books written about how terrible the company is, multiple books, like it's a whole thing. So if you're Meta, I think you're like, okay, I mean, we can get ourselves through this. And I think all social media companies or companies with that general business model, which OpenAI is gonna get lumped in with that group when they come public, ad-supported, mega network effect type business. I think whatever you think your pain tolerance is what you have to endure publicly to reap the profits of how good this business model is, make that tolerance way higher. More. Right. You can endure way more pain in terms of public perception because the business is so good. So maybe that's the big tobacco tie-in. Like it's still been great to be an Altria investor, a Philip Morris investor over the years. People still smoke in large enough numbers that works. There's like an addiction dividend, right, that comes back to the business. And it's a better business. It's not a vice business in the way alcohol is. Those stocks have not performed as well. That business does feel like it might be at some sort of terminal decline where your consumers walk away and don't come back. But I think social media, it feels more big tobacco-y in terms of, how hard it is to stop a scroll session.
Yeah.
Whatever it is.
Well,
I'm sitting here as if I'm not watching YouTube Shorts for an hour.
Well, and the companies have said they've tried to improve, make the stuff less addictive, but Miles Udland is Exhibit A of how that's not working.
Yeah, I think it's like creators are so good at like knowing how to cut to the moment, and the algorithm is so good. Like this is the thing that I'm always amazed at when you get in one of these like scroll loops, is how infrequently the next thing that comes up feels totally incongruous. Like it's not that it's related to it, but like there's something in your brain where it's like, yeah, I understand why it went from this to that to the other, and why I'm still watching.
Listening to you, I just have no FOMO whatsoever. I'm just so glad I'm not to be smug, but I'm so glad that I'm not doing like.
Brings up our generational discussion earlier today.
Yes, it does. That I'm Gen X and smug by
you just like to be
smug by
about
upbringing,
everything.
I guess.
Yeah. So what do you? So you're sitting there reading your book, your hardcover book.
Sometimes.
Ink on page.
Sometimes.
Thinking about getting so learned, being like, oh, I'm so much more intelligent than these millennial parents.
You know what I am addicted to, and I can't be smug about it, and this is sort of embarrassing. The New York Times Games app, which is really sad. Yes, I know it's sad. Just one more quick comment. Yes, you'll be laughing at me about that all day. I understand. It's like so on brand as anything ever been like, so on brand.
You know what I'm
addicted
to? I'm addicted to the least fun version of games that's given to me. But like it's very Catholic of you to be, even though you're not Catholic, to be addicted to the New York Times crossword or whatever, the game
No one will be
section
suing the New York Times about the addictiveness of their games app, I can assure you.
As a Soma resident. Unbelievable. God, that's so perfect.
I know.
All right, what do you want to hit me with here? We got 90 seconds.
I was just going to bring up, while we're talking about the addictiveness of businesses, I was just going to bring up prediction markets and sports gambling, because if we're talking...
Yeah, we hit it Tuesday. You weren't here. I know it's a big one for you.
But if we are talking about a business that has been attacked, if we're talking about this court ruling with Meta and YouTube and the harm it's causing, I mean, I'm sure there have been court cases already about sports gambling, but you have to imagine that more of that is going to
Kalshi and Polymarket came out Tuesday with their new rules for their platform in response to proposed legislation.
That's right.
So it's one for one. But origin of that, big day for the Substackers, is the Derek Thompson Substack this morning, which you sent me, about his view, and he makes a pretty compelling case on the depressing outlines of the gamblification, let's say. I don't think it's not the word he uses, but and
I like it.
It's not a great word. I think there's other ways to do it, but like everything is gambling now. Everything's a bet.
Yes.
And it doesn't really, it has deleterious effects, let's say.
Yeah, and
on balance.
Unfortunately, he didn't seem to have any proposed remedies in his piece. It was more just like, everything is terrible. This is why it's so terrible.
This is like a publishing thought that I had, which is because he publishes. I'm not a paid subscriber. Apologies, Derek. But I get the free previews. He publishes early in the morning, which is it's a good train read. But it's like, right, when it's only depressing, it's like you're sitting there and the depressing hot lights of a New Jersey Transit train that's not going fast enough. And now I'm hearing about how there's no solution for all these problems facing young people in America. And it's like, well, at least only one of the escalators is broken at Penn Station.
That is true.
Have you noticed this? There's two coming down and one going up during the morning rush.
I noticed that today.
They didn't figure out that you need two going up when people are coming out of the station.
The time that I come in, it's not a problem.
All right.
The time you come in, maybe it's more of a problem.
All right.
That doesn't.
Futures are lower this morning, by the way. Sazi will get us straightened down on that front.
He will, and oil is higher.
There you go.
Talk about that a little bit.
There you go.
All right, that does our morning brief. As promised, Brian Sazi is up next on Yahoo Finance.
It's Thursday morning for the stock market. I'm excited about it. I know you're excited about it. So let's have some fun today with all the insanity out there, whipsawing stocks, bonds, Bitcoin, gold, and 100 other asset classes I'm just not going to name right now. Here's what's on my mind right now. It's more like the miserable seven. All seven magnificent seven stocks are down double-digit percentages from their 52-week highs. Don't love to see that. Speaking of the Mag 7, Meta and Google shares getting hit after a jury found they harmed a young user with design features that were addictive and led to her mental health distress. Meanwhile, Goldman Sachs out with a new chart showing that, you guessed it, still no ships are going through the Strait of Hormuz. I know you're very, very shocked about that one. Meanwhile, Barclays says it's time for you to buy the dip in gold. I like that upbeatness. Meanwhile, Scott's Miracle-Gro hit with a JP Morgan downgrade because the war in Iran has sent prices of chemicals soaring. And I'm reading this, and I think it's just going to cost me a lot more to fertilize my awesome, awesome green lawn. And last but not least is the one from Bill Sparrows over at bookies.com. The cost of 4 tickets, parking, 2 beers, 2 sodas, and 4 hot dogs at the Los Angeles Dodgers Stadium is the highest in all of MLB for the second straight year. It's nearly, get this, like, I'm blown away by this number, $200 above the league average. Maybe if Fed Chair Jerome Powell were to hike interest rates, he would crush this Dodgers Stadium inflation. Jay, we need your help. Maybe this is your final act as Fed Chair. Here on the Opening Bid Roundtable, Kenny Polcari, Slate's own Wealth Chief Market Strategist, alongside Yahoo Finance Senior Reporters Brooke DePalma and Nez Ferre. Kenny, can you believe that Dodgers inflation? I mean, that's just crazy, Kenny. Come on.
It is. It's out of control. But, it seems to get worse and worse every year. So, yes, to your point, maybe Jay Powell can help us.
I wish he would help us. But, Kenny, I started my long list of things that I'm watching this morning on the miserable seven, a.k.a. the Mag 7. I mean, all these stocks down double digits from their 52-week highs. And we're going to talk about oil. We're going to talk about pressure in the markets. I'm going to go to Nez on that. But I want to come to you on the Mag 7. People are now talking about this. Is now the buying opportunity to these stocks?
So I strategically, not all of them across the board. Just don't go in there, blindly and buy everything. I think you have to look at the biggest names like Tesla. I've never owned it, so I'm not one that, even though it's down 25%, I'm not one that would jump in. Although I love what Elon Musk does, I kind of missed that trade, and I'm just not. There's just nothing about it that drives me. But some of the other names, Microsoft, Nvidia, Apple, 100%. Meta and Google now, because we've got that recent court action, I'd be a little bit careful because I think it's going to open up the doors to so many more potential lawsuits like it did during, when the tobacco industry gets slammed. But I think that too will pass. I'm just not so sure that right now the time to jump in. I think there's a little bit more downside risk to them. You can already see that there are a whole load of other lawsuits that are already being filed.
And as before the Operation Epic Fury took off, you were my Mag 7 lifeline. I think the market has forgotten about these stocks.
The market has perhaps forgotten about these stocks, or perhaps the market is focused on other areas of the market as well. But look, to Kenny's point about Meta and some of these other, the social media sort of realm here, that is something that has been also written about since this ruling, because it could open up now the door for other lawsuits to come through. And this could be the moment, the tobacco moment, so to speak, for the social media industry. So it'll be interesting to see what happens from here and how they navigate this.
And let me stick with oil here. Oil, of course, remains probably the main market driver. I just had to swab the deck of these Mag 7 stock price sell-offs here. What are you hearing? What is the latest on oil here this morning?
So we are seeing today oil going higher. You have President Trump that has said that Iran needs to get serious soon before it's too late. They sent out that 15-point ceasefire plan to Iran. That included opening up the Strait of Hormuz. And Iran has rejected that because that continues to be the focal point here. You mentioned Goldman Sachs's chart on the Strait of Hormuz. Traffic is down 96% through the Strait of Hormuz. And now you have Lloyd's List and Bloomberg also reporting that Iran is charging some vessels, the vessels that do get to trickle out of there, they are charging up to $2 million for those vessels to go through. So it's sort of a toll booth system. This shows you two things. One is Iran's stranglehold on that area, correct? Its influence over the Strait of Hormuz. And the second is the desperation from customers that are paying in order to get those vessels through.
Brooke, Brooke, I'm so surprised. I know you were looking at a B of A note this morning, looking at card spending trends. I was looking at the same note. I am surprised with gas prices approaching $4 a gallon on average nationwide. I even posted a chart on X this morning. There's an infamous LA gas station that is close to $9 a gallon. I mean, that's insane. But I'm surprised this really hasn't hit consumer spending yet.
That's absolutely insane. $9 per gallon. I'm walking. I don't care how far it is. I mean,
it's crazy.
What we're hearing is that is nuts. So, I mean, what we're hearing from Polymarket is the users do think that gas prices will hit $4 per gallon by the end of this month. But Gas Buddy analyst Patrick DeHaan actually said that with the current price of oil, it's quite likely that we'll actually hover around this $3.97, $3.98, $3.99. We might not get until $4 by the end of this month unless we see some sort of escalation here. But as you noted, this has not really hit consumer spending. If anything, consumers are actually spending more. And based upon that B of A note, what we saw was that Gen Z and millennials are actually spending more on gas. Think about it, Gen Z now commuting to the office for the first time maybe ever. Of course, younger Gen Z, that is. Also millennials, they now have families. They have to go to work too. And so they're spending more money on gas now. But at the same exact time, what we also saw within that Bank of America note was that they're actually spending more on electronics, on clothing, on restaurants, on experiences. And what that might be because ultimately Gen Z and millennials are making more money. Based upon what Bank of America put out is that their wage growth has also increased year over year, up about 9% for Gen Z, up about 2% for millennials. And so, yes, we're seeing higher gas prices, but maybe they're making more money and they're still willing to go out and spend.
Kenny, can you imagine paying close to $9 a gallon for gas?
No, can I just jump in there and say one thing? Because I got to ask you a question. It's $9 a gallon in California right now when oil is trading at 93. When Biden was president and oil was over 100 for 3.5 years, or for 5 months, I guess it was for Obama, it was over 100 for 3.5 years. But under Biden, it was ahead for 5 months. Did that gas station charge $9 a gallon, or is this Trump derangement syndrome? They're just trying to prove a point. Look what he did. Let's raise the price and scare everybody. It's baloney. It's
Kenny,
baloney.
you're always fired up with me on all things oil, but like that station is a lot. But gas prices are high. I mean, are you surprised that it hasn't hit consumer spending yet?
No, I'm not, because I think it's going to start to hit consumer spending if it stays elevated, right? There's like this lag period. I will tell you, I went and filled up my car last night, and 2 months ago it was filling up at $48 a gallon. Last night I paid almost $70 to fill the tank because I was really on empty. I wanted to see what it was going to actually cost me to fill it up. And so, yes, suddenly I went, wow, that's like an extra $25 every time I fill it up. And I don't drive that much. I go 6 miles back and forth to work. But, for other people, that's clearly going to start to, to eat into their budget. So I would expect if oil stays here like this, yes, then you're going to hear more people kind of moaning about it and whining about it and being upset about it. I get it. But I'm going to be in the camp that I think this is not going to last that long, that there's going to be an end to this. And when it happens, I think we're going to see oil come right back down, at least to the mid-70s, right? It should go back to the 60s where it was, but it probably goes somewhere in the mid-70s and just kind of churn there until it figures out kind of what the next step is.
Yeah, that's what I was hearing from Barclays too this morning, Kenny. That's a good point. I think their case was that when it does fall, probably between 73 and $76 a barrel. I mean, if that's the case, though, Kenny, do you start building positions now in some of these consumer discretionary names that have gotten beat up?
I think you can. And again, I like to be very strategic, right? As an advisor and someone that builds portfolios, I just don't go, buying haphazardly and passively across the board. We'll look at individual names. So yes, you got to look at some of these names, especially the big mega cap names, the large cap names that have gotten unnecessarily beaten up just because the broader market is trading lower and people get nervous. So they sell what they can versus what they should. And that creates longer term opportunities in very, very high quality names. And so, yes, I think you can start looking, but you need to be strategic about some of those names, right?
Inez, over to you on gold. I was surprised. I have a story going up too on our homepage on this one, but I was surprised to see Barclays come out here trying to pick a bottom in gold. Gold has been hit hard, and they're really one of the first ones to stick their neck out and say, you know what, maybe the selling's a little bit overdone here. Let's go out there and start buying some gold.
Yeah, they're saying basically that this is a good entry point. They're pointing out that gold has had a good run over the last 3 years. You saw it erase its year-to-date gains with the Iran war, and that it's basically because of the rate hike fears, because of inflation. You've got some central banks that may be selling some of the gold because they're trying to defend their currency. But they're saying that this could be the time. They also pointed out the Fed has missed the 2% inflation target for the last 4 years. They do not see the Fed hiking this year.
Brooke, somewhat off script here. Did you see those new K-pop Demon Hunter Happy Meals? I saw what McDonald's is doing there, but also I got some data, I think it was yesterday, on increased traffic to McDonald's restaurants because of the big arch. Maybe that CEO, maybe Chris needs to put out some more of these videos that go viral.
Well, what's funny, Brian, is he actually put out that video in the beginning of February, but it didn't get traction from social media. And this just goes to show the algorithm that these social media players have, that this video sort of went viral at the end of February, early March it was, even maybe into March. And so, I mean, sure, he took this bite. Everyone wanted to reenact the moment. There were so many memes on social media. I mean, we're talking thousands of memes. Then you had other restaurant players get in. And so that's the kind of buzz, maybe kind of any press is good press kind of moment for McDonald's there. So I'll be eager to see when they have their earnings call this spring to hear if they even mention if they did get a lift in foot traffic. But what we have seen over the past few years is McDonald's come out with these mega marketing campaigns. Like, think about Monopoly and how well that did for McDonald's. And so K-pop Demon Hunters, probably a similar expectation there. Also looking out for their beverage platform as well. And if you pass by any McDonald's in the city, you're going to see at least 20 DoorDash drivers outside of it waiting for deliveries. And
so true. So true,
definitely
Brooke.
McDonald's having a moment.
Kenny, real quick, last word to you. I'm sure you saw that news that hit late yesterday on Meta and Google, that jury finding. Are you a buyer of these social media stocks on something like this?
No, so again, to Inez's point, I'm not yet a buyer. I never owned Meta and I never owned Google. Very interesting. But I'm not yet a buyer of that. I think this lawsuit has opened up the door. There's going to be more. So I think there's going to be a little bit more fallout. And at some point, look, they're down 25 or 20% or 27%. At some point, they're going to become a value play, right? And so certainly that will raise the interest. But I never owned them. I'm not going to jump in on them now. There's other places for me to put my money. And I'll say one more thing. I missed that whole K-pop thing. I have to go searching for it because I have no idea what you guys are talking about.
You're not alone, Kenny. Kenny, I just want to say this to you. Kenny, before I let you go, though, Kenny, I want to say this. I do not own that gas station in LA with $9 gas. It may sound like it because I'm like on TV and I'm reporting these things, but I just want you to know that's not me. I don't own that thing. And it's not my decision what to do.
I'm not going to California. No interest. I'm very happy here in South Florida.
Okay. All right. Good to see you guys. Kenny, Brooke, Inez, enjoy McDonald's. We'll talk to you soon. For more Polymarket odds, you can scan the QR code on your screen to go to the Yahoo Finance Prediction Markets Hub, powered by Polymarket. I head here first thing each day to get the pulse of what could be hot in the markets. And you should do too, just like me. Mercedes-Benz CEO Ola Kalinis is reinventing a 140-year-old auto icon. Here's a clip from him discussing driverless cars in a new episode of my Opening Bid Unfiltered podcast. You can watch the full interview on Yahoo Finance, YouTube, or listen in on Spotify, Apple, and Amazon.
If you buy a sports car like you have done, of course you enjoyed the driving. You want to do that. That's part of the whole story of the fun. We're not going to take that fun away from you, but imagine you have, maybe in the future you have an S-Class, you have worked hard, it's late, you're tired. If you can just push a button or tell the car to drive you home in a relaxed way, why wouldn't you want to have that? So it's not an either or, I think it's an and, but autonomy is happening and we are at the forefront of that.
Coming up, a read on the ever-evolving cryptocurrency landscape. That's next on Opening Bid. While Operation Epic Fury continues to send tremors through the oil markets and the S&P 500, the digital safe haven thesis is being put to the ultimate test as seen through the daily volatility in Bitcoin. But the real story isn't just Bitcoin's surprising resilience right now, it's the total institutionalization of the rails. Just this week, the SEC and CFTC dropped their landmark joint guidance, finally clearing the fog on crypto classification. And with the Genius Act officially moving stablecoins into the regulated digital cash category, the era of legal limbo is over. I want to put the spotlight on one player you probably haven't heard of just yet, that is OKX. They recently snagged a reported $200 million investment from the New York Stock Exchange, valuing its crypto trading platform at $25 billion. The duo will work on several initiatives, including the tokenization of stocks. Haider Rafiq is a global managing partner and CMO at OKX. He's here with me now. Good to see you.
Thank you.
Thanks for stopping in. So for those not familiar, before I get into the news and what y'all have been up to, what is the OKX platform and where do you fit into this ecosystem where there are a lot of other competitors?
Well, look, we've been building quietly for the last 10 years, and that build-up has now put us in a position where we're managing the second largest crypto derivatives markets on our venue. At any given day, we're on the top 5 list of spot markets. So that's a lot of work in the background on building an infrastructure that is reliable. We do this in one of the most demanding markets, starting from Southeast Asia to Europe, Middle East, Latin America, and most recently, we're bringing that strong infrastructure and its validity to the United States. Now, the big opportunity with the United States is, or crypto markets in general is, if you look at retail or institutions, there's less sort of desire in terms of new listings and new tokens or DeFi. What customers, what people, investors are looking for is, how can I trade and access these equities and financial instruments the same way I access the internet? Now, you look at the internet, we don't have market hours for internet, or your on-demand apps or your delivery apps don't have market hours. So the younger retail investors are expecting that same experience when it comes to trading and investing. And that's where I think we bring a tremendous value. We've done this at scale. A lot of companies are talking about 24/7 trading. We have a unified global order book, and that allows us to have the strong infrastructure and bring it to a company like, say, ICE, which has tremendous credibility, not just in the United States, but globally.
For someone who doesn't have your global view on all things crypto, how are the markets, the crypto markets in overseas different today versus the US?
The U.S. Investor typically has a higher buying power, so to speak. So their behavior is more buy and hold, less trading. There's a smaller group of people who tend to be traders here. But when you look at markets, emerging markets in particular, where there's high inflation rates, they're looking for more aggressive returns. So you see a different behavior there, where they will have more trading activity and they'll be aggressively participating in new DeFi protocols and new instruments.
How will tokenized stocks change the investing landscape? I've heard this about tokenized stocks, I think, for the past year and a half, but for those not familiar with it, how does it change their lives?
Well, look, I think it's a basic principle back to how internet operates, how our on-demand economy operates. Investors today want to be able to price their assets when real-time events take place. This is why crypto markets have been so attractive to them. Now, when you tokenize equities or perhaps futures in the United States, 2 things happen. One, it's about accessibility. So now you could be on a Sunday morning recalibrating your positions, or any given day during the night or what have you. And the other thing that happens, which I think is more exciting for the US economy, is you have an equities market about 50 to 60 trillion on any given day. Can you imagine what happens when we open up these markets to foreign investors? Today, out of that 60, 70 trillion, you have about 18% foreign investors. Once these things get tokenized, they go on chain. They're accessible 24/7, and they're accessible to people around the world. Can you imagine what happens to our equities market cap? New liquidity comes in. It's great for the companies that are on these exchanges, and I think that's great for the American
What does
economy.
happen? Because I think you're bringing up a very key point. What happens here?
I think over the next 6 to 8 months, we see an acceleration of TradeFi companies making big bets, partnering with crypto companies, using their infrastructure to accelerate their tokenization efforts. I think it's going to happen not just by one company, but I anticipate that this is going to happen across the Wall Street, and you're going to see brokerage platforms, you're going to see large exchanges, you're going to see market makers, everyone make large investments towards on-chain infrastructure.
Are the regulators getting on board with this?
I think so. You hear Chairman Paul Atkins, he's put a couple of statements out there that over the next 2 years, he thinks most of financial assets will, in some capacity, be on chain. So I think regulators are definitely supporting this initiative because they understand this is great for the American economy.
What do they need to hear to ultimately convince them? They always feel like they're 37 steps behind on everything.
Well, look, I think they're all about consumer protection. This is why we partner with one of the most credible institutions in the market, ICE and New York Stock Exchange. So what's going to be important for them is, are these crypto companies that have largely been, young incumbents, have they developed the maturity to have the right compliance controls in place and have the consumer protection in place so, somebody, an average Joe, doesn't lose their shirt? And I think that's probably the most important point for them.
What are you helping ICE build? What is that technology infrastructure that you all are laying?
So when you think about the 24/7 trading we facilitate globally, that is built on an on-chain infrastructure and custody models. We're bringing that over to NYSE. We're going to partner with them and co-build a platform. And what that platform is going to end up doing is having their equities, NYSE-based equities and futures products, come on chain. And we are ultimately going to become one of their front ends, a consumer app, if you will, that will offer those equities. I think we will probably have a first mover advantage on those products.
How did they come to you?
I think it was a combination. I ended up going to meet them last year in the summer. And it started with what was meant to be a 30-minute conversation, ended up being a very fruitful 4-hour conversation.
With Jeffrey, the head of the
That's right. That's right. And I think that followed with a number of months where we ideated on products and our vision, ultimately leading to a very fast-track due diligence over 3-4 months. And we're glad we got it done.
4 hours, that's a lot of time. Where do you see this partnership going over the next few years?
I think our vision is that we want to be the most reliable infrastructure partner for ICE and ultimately open up the US markets to hundreds of millions of retail investors around the world. And I think that's a passion point for us. We have this technology, we've battle tested it in crypto markets, and it's exciting to see how that would work out in tokenized equities and futures.
You think about the stock market, and there's so many Wall Street financial firms still, bulge brackets of smaller firms. Why is the crypto market able to support what you are doing, a Coinbase, a Robinhood, and a Kraken? I mean, there's so many other exchanges down the line.
Well, look, these were technology first companies. They weren't financial services first companies. And I think that's the moat that companies in crypto category have. They have the best infrastructure to be able to realize this vision. And I think that ultimately puts us in an incredible position of advantage. Now, you have to consider this. I don't think we can do it without TradeFi. This is a convergence of TradeFi and digital asset economy. And I think that creates equal opportunity for both sides.
Last one, can you help us understand the resilience we have seen in Bitcoin? I'm not asking for a price prediction. I know you're not going to do that. But why the past month when the market has gone, and you see so much volatility, oil markets, stock markets, Bitcoin has hung tough. Why is that?
Well, look, I can give you one anecdote. The interesting thing we noticed after the conflict began, or even when AI started to soften the earnings and the markets in general, is we saw a lot of impacted markets start to pull out their deposits, their cash deposits, and put it into crypto exchanges and then purchase Bitcoin. Now, that's a really interesting behavior. So, that tells us if there's volatility in the world, people want to take some risk off, whether it's a dollar position or equities, and they want to put it in a self-custody wallet where they feel they have control. And I think that really builds the fundamental resilience Bitcoin has.
Well, I think you're working on some cool stuff, Hire, you and the team, and looking forward to following your journey. Appreciate it.
Thank you. Thanks for having me.
All right, that's it for Opening Bid. Go listen to my new Opening Bid Unfiltered podcast with the CEO of Mercedes-Benz on Spotify. Go, go, go. Listen. It's a good one. Yahoo Finance Market Catalyst. It's next.
Welcome to Market Catalysts. I'm Julie Hyman, and we're 30 minutes into the U.S. trading day. So let's take a look at what is going on in the markets right now. We do have a mixed picture for the major averages. Right now, the Dow's hanging on to a gain of about 1/10%. It's up about 67 points or so at the moment. But the S&P 500 is pulling back about 1/3%. And the NASDAQ is down about 0.6%. Of course, the market is still laser focused at what's going on in the oil markets, energy markets, and all of the headlines coming out of Iran as that war continues to go on. We continue to watch, of course, what's going on cross asset as well. We're seeing those yields pick up a little bit today on the 10-year. The trend has been mostly higher over the course of this conflict as the higher oil prices have raised concerns about inflation. So that's something that investors are weighing. We've got the dollar showing a little bit of strength today, and it's up a bit as well year to date. And of course, we continue to watch what's going on with crude oil futures. There's quite a year-to-date chart that we're watching. Today, oil up about 3%, trading at around $93 a barrel. But we continue to watch as well what's going on with those oil futures, WTI, which is here mostly domestically traded. And then you've got the international benchmark Brent, which is still above $100 a barrel. If we look at what's going on under the hood in stocks today, sector-wise, and what's on the move, what's dragging, we've got tech, actually, that's the biggest drag. That explains the underperformance in the NASDAQ today. Communication services, too. On the plus side, consumer staples, real estate, and energy continuing to gain. So when we're talking about that weakness in technology, where is that weakness being expressed? We've got Meta down 3%. That's after that court finding yesterday in California. The company liable for about $4.2 million in compensatory and punitive damages in the case of a young adult who said that the platform had been harmful to her. YouTube as well was included in that decision, although its damages are much lower. So a lot of discussion, even though it's not a large amount for Meta, a lot of discussion about what that means. Does it set a precedent for both other court cases and maybe even regulation going forward? Those shares down 3%. NVIDIA, Alphabet, of course, the parent company of YouTube, are falling as well. And we've got some of the memory chip makers under pressure. We're going to get into that a little bit later on. But I do want to get back to what's going on in the oil markets, because that has been so very interesting as we've seen energy stocks consistently outperform. Joining me now is Rob Thummel, Tortoise Senior Portfolio Manager and Managing Director. And Rob, I'm just back from Houston, Texas, where the CERAWeek conference is going on. A lot of energy and power industry executives gathered there. And there was definitely some chatter here that this gap between the physical markets, which are priced much higher, and the futures markets, that maybe we're going to start to see those futures prices, especially as the war persists, start to come up a little bit. What do you think?
Well, thanks for having me, Julie. So I think obviously what the world's learning is energy is really important, and obviously you learned that at CERAWeek, but also oil's still relevant, right? I mean, and we need physical flows of oil for the domestic economy to continue to prosper and for the global economy to prosper. So if we can get physical flows of oil to restart and be more consistent and steady, then I think we can see an improvement in oil prices. If not, we will likely see oil prices continue to rise. And I think the consensus is getting to be now that potentially that we're not going to see the physical flows come back as rapidly as everybody thinks.
I spoke to Dave Ernsberger, who is the president or the head of S&P Global Energy, and here's what he told me about the potential impact on prices.
Our forecasting team at S&P Global Energy now predicts that if the war was to continue and the strait was to remain closed, we could easily see $200, $250 a barrel as crude prices.
You know, and he talked, I said, what would need to happen? Like, how long would it need to persist? And he said, maybe another month or so to see those prices. What do you think, Rob?
Yeah, I think that's the longer this persists, the longer you take in, millions of barrels a day of supply off the global markets, the more inventories fall, and then the more likely the prices continue to rise, because for economies to continue to move forward, you need oil, and we have some inventories, and we have some inventories for days or maybe months. But longer term, you're going to need a steady supply, a global oil supply to keep really both the global and the domestic economy moving along at a nice pace.
Rob, I was also interested to see the Dallas Fed survey, their monthly survey come out today. Specifically, they focused on energy and they surveyed energy executives and asked them what their forecast for prices are going to be. And 6 months from now, the average was $78. But I should mention the range was very high, and there were some very high estimates out there. And then 5 years out, it was $79. So not much change, interestingly enough. Further out, how are you thinking about sort of the long-term prospects for energy? Because it should be pointed out, before the war, the outlook for prices was not great.
Oh, you're exactly right. You're exactly right, Julie. It was $55 we started the year at US WTI, and Brent was maybe $5 ahead of that. But here at Taurus, I still think that we think that oil prices they're not going to go to astronomical highs. We want the oil price to be at a level which is more of the Goldilocks scenario where obviously the producers can still earn an adequate return, but we don't want oil to cause significant inflation. Oil's really important. Energy's really important. But I think we have plenty of oil in the world, and fortunately, from a U.S. perspective, the U.S. energy industry has done really a fantastic job of growing the oil supply, so that when we have had a significant supply shock like we are in right now, oil prices don't escalate and stay high for a long, long time. So I think oil prices they can come back down into the 70s and even potentially into the 60s longer term.
Rob, so let's talk about the implications for some of the companies, right? Because it doesn't, we're not sort of getting indications, particularly from the oil producers, that they're jumping to increase production at this point because there is this uncertainty about how long this is going to last. So if you're an investor in these companies, how do you think about who's best positioned? Do you sort of put the war to the side when trying to make that decision?
Yeah, well, I think, I do think you put it aside. I think a lot of investors are underinvested into energy in particular because, people thought energy was going away, oil and gas were going away. They're not. I think it's become very clear that we're going to need a lot of oil and gas, and economies need a lot of oil and gas. We need a lot of energy infrastructure as well. And so I think as investors, I think you need to look at, individual companies and their opportunities, both domestically and globally. At Taurus in particular, we like natural gas and how natural gas is positioned a little bit more than oil longer term. I mean, we just see electricity becoming the new oil and natural gas being the primary fuel supply source for all of this electricity generation that we're going to need. That's really driven by a future AI-driven economy.
Being at CERAWeek, there was a lot of talk about permitting reform, Rob, as you might imagine. And one of the bottlenecks that I heard about is that, we're drilling this natural gas, we're producing this natural gas, but there are a couple of bottlenecks with it. One is pipelines, right? Just having enough pipelines getting the gas, whether it's for export or domestically, where it needs to be. And two is the equipment needed to then, gas turbines and such. I'm curious on the pipeline front. Is this a reason you'd want to own pipelines? Are you optimistic about maybe some of that permitting loosening up and us actually seeing some more construction on that front?
Yeah, well, I think what the last maybe month has shown us is energy infrastructure is really important as well. And the great thing in the U.S. is the U.S. operates the largest energy infrastructure network in the world, and so pipelines are a great place to be. We've been investing in pipelines at Tortoise for over 2 decades. They offer some fantastic dividend yields, some dividend growth, and you're right. It's hard if it's hard to build new pipelines, then the value of the existing pipeline network we think is worth even more.
And you like something like Williams on that front, I guess.
Williams in particular, because it operates the largest natural gas pipeline in the U.S. And like I said, we think that natural gas is going to be a really important commodity. We're going to see a lot of growth in natural gas demand, and a lot of that natural gas is going to have to be transported through a company like Williams's pipeline network. And Williams is doing some innovative things in terms of behind the meter power, providing power behind the meter to help really develop AI going forward as well.
And another one of your picks on the natural gas front is Cheniere, which is a producer of natural gas. How do you sort of focus on Cheniere over the other producers? What advantages does it have specifically?
Well, Cheniere actually exports natural gas, Julie, and so that's for the unique aspect here. Not a lot's been talked about, but what's happened to international natural gas prices really over the last month. They've risen, 60-70% versus U.S. natural gas prices that are barely up. And so what that means is there's a strong demand for U.S. Liquefied natural gas internationally, both in Europe as well as in Asia. And so Cheniere, in its case, it's the purest way to play U.S. Liquefied natural gas exports. We continue to expect to see over the next several months, years, and decades more and more U.S. liquefied natural gas exports, and Cheniere will benefit from the growth in the demand for more U.S. LNG, both in Asia and Europe as well.
Rob, good to see you. Thanks a lot for joining us.
Thanks for having me, Julie.
Coming up, Meta and YouTube found negligent in that landmark case on social media safety. We'll talk about what it means for the companies and for consumers going forward. That's next. Meta and YouTube found liable in a landmark social media addiction trial. Our tech editor, Dan Halley, has been covering this case, and he is with me right now. So both Meta and YouTube will have to pay fines related to this. They'll probably appeal. But I wanted to talk, now that we've had some time to digest this, wanted to talk a little bit more about the implications of this. And both of these platforms, Meta in particular, has said we've made changes already to try to address some of these concerns about addiction. The question is, are those enough of a remedy, I guess, and what other remedies could we see either the courts or legislatively be imposed on the company?
Yeah, I mean, it's interesting, right? Because, there are, Apple has, this is separate from Meta or YouTube, Apple has screen time, you can just blow past that, right? You can just...
Can you? My kids haven't, I don't know that
well,
my
no,
kids have figured out.
if you're an adult or, whatever.
Okay.
So that's
I
like
have controls on my kids' screen
yes,
time. Those are pretty hard. Like, it will not allow them to do stuff. I also have to approve their apps.
Right. Which is, at that level, I think that makes sense. But then if you allow them to get access to these platforms, the big thing about what Meta has talked about when it comes to taking care of the business that they've been dealing with, teens and complaints that it's bad for kids' mental health. Some whistleblowers coming forward saying, here's the documents, we got the receipts. You know it.
Well, and some of the documents were brought up in the trial.
Right,
also,
right. Francis Haugen, who had gone before Congress to kind of be a whistleblower. A lot of these things that you see, integrated suicide prevention tools, restrictions around private chats with teens, prompt teens to take time away, set daily limits, launch teen accounts. This is all keeping you still on the platform, right? And so this wasn't a case about content. Right, it
was the design of the platform, whether it is designed to be addictive.
And that's what made this such a unique case, because everything you've heard from politicians, and look, maybe there's one or two, politicians don't know about this stuff. They're like, what's a Facebook? I mean, what was it? Who was it that asked?
They know what it is, though.
I mean, they asked Mark Zuckerberg how he makes money. Like, that's crazy, They asked Sundar Pichai what's wrong with the guy's iPhone. It's like, what's happening here? Like, out of touch is out of touch. So there's some that aren't. But the big deal here is the uniqueness of how they approach this, saying, okay, you can say that Section 230 of the Communications Decency Act shields you when it comes to what's posted, and that's been traditionally what's gone on, right? And so the internet wouldn't exist as it does if it was not for Section 230. And we wouldn't have comments on our website. We wouldn't have. You wouldn't have anything, right?
Right. But the issue is not the content. The issue is the design of the product and whether it is in fact designed to be addictive.
Exactly.
So now what?
So now, obviously, they're going to appeal. If they win, then it doesn't necessarily mean that this is over, because there are still hundreds of other cases waiting in the wings. And when it comes to a win, it's a benefit for the plaintiffs, because or future plaintiffs to say, well, we have this happened over here.
But also, does Congress come in and say make the product less addictive, whatever that would entail?
I think at a certain point, if there's this steady drumbeat of wins, then eventually Congress has to come in and do something, right? I mean, granted, there's been discussions on what can they do now. Or what could they have done in the past. There have been different things put forward about, should you have age restrictions? Should you not? Should you have ways to identify how old people are?
Right.
And then the questions of, okay, well, then there goes the anonymity of the web, which is kind of the most powerful tool of the web. And so, I think eventually what happens is, if all goes against these companies, they do ultimately have to change fundamentally the foundations of their products.
Right.
And the infinite scroll, either on Reels, perhaps TikTok. They settled, but that doesn't mean they're Congress would be like, okay, well, you guys settled, that's fine. So we could end up seeing these big major changes. That's what keeps people on right?
Yeah.
That's how they can sell that to advertisers, and that's how they make their money.
I mean, I thought it was interesting. We initially didn't seem to be seeing much reaction in Meta shares.
No, not at all.
Right now, they're down a little more than 3%, which is not a lot.
It's not people.
But it's not
freaking.
nothing.
Right.
And it's not amidst a huge decline overall in tech today.
Right,
Meta
yes.
is underperforming the market.
Well, look, they shrugged off, what was it, a multi-billion-dollar fine. I think it was the FTC. I can't recall off the top of my head.
But the money isn't the point.
Right. I think people are looking at right now saying, oh, they paid $6 million, no big deal. I don't think they're recognizing that if this goes against them for so long,
right.
and it feels as though there's momentum now. We saw in New Mexico, obviously a different type of case, but that went against Meta. There's this, I think if you talk to, you're looking at jurors, and you could tell them not to take anything outside of the case into account. But they've
humans
heard,
are humans, yes.
And they've heard that social media is bad for you.
Yeah.
Right. So, and look, I find myself scrolling, and then I'll just look up like, what the hell just happened? Right. Like I was in a daze.
This is why I stopped.
I mean, I've deleted it, downloaded it, deleted it, downloaded it, deleted it, downloaded it. I go back and forth. But I do think, eventually, if this does have to change the way these companies function, man. I mean, what are you going to
do with all your free time, Dan Howley?
I'm probably going to sleep a lot more. But it could be fundamentally damaging to them in an incredible way.
We'll see. We have a
long
to
way,
go
yes,
before
yes.
here and there. All right, thanks a lot, Dan. Appreciate it. Coming up, we'll go live to the NASDAQ with the top analyst calls on Wall Street. We'll be right back. get to some of today's trending tickers. We are watching memory chip stocks, Olaplex and Henkel and Navan. First up, let's get to the memory chip stocks. This is a really interesting story. Google out with some research that basically talks about new memory compression technology that would allow large language models to operate with less memory, fewer memory chips, in other words. What's interesting about this is the research actually didn't come out just now. It came out something like last week, or last year rather, and the company is just now sort of republicizing it, if you will. But what's interesting is it's hitting some of these memory chip stocks here. We've got Micron, SanDisk, Western Digital all down. Of course, the context is these stocks have performed very, very well year to date. So this sell-off coming on the back of that. And there has been some pushback by analysts that this idea that Google's putting forward would actually fundamentally affect the demand for these memory chips, which are in very short supply and on back order. Let's also talk about Olaplex and Henkel. Olaplex is selling itself to Henkel of Germany for $1.4 billion. Now, why is this interesting? Olaplex, if you're not familiar with it, is a hair care brand. And when it first came out, it went viral. In particular, it was known for its leave-in conditioners. I have one sitting in my cabinet that's been sitting there for some time. But then there were some lawsuits and complaints about the company that it was actually causing damage to hair. So the stock took quite a hit. This is one of the crop of the class of 2021. It had its IPO in 2021. And the IPO, by the way, was at $21 a share. It's now selling to Henkel for $2.06. So yes, the stock is up, but that puts it in a little bit of perspective. And finally, Navan, this is an online expense management company that has been gaining some market share. And the company came out with an unexpected profit last quarter. Revenue up 35% year over year. The shares are up 24% today. Bloomberg Intelligence out and talking about that this company is turning free cash flow positive on the back of these numbers it just reported. That is ahead of schedule, according to other analysts. And Bloomberg Intelligence says that the agentic AI tools that Navan makes should continue to disrupt legacy providers in the corporate booking space. By the way, this one is also a recent IPO, and the stock is also down since its IPO. Went public back in October at $25 a share. While it's up a lot today, it's still just over $11. By the way, you can hear from the CEO of Navan. That will be later this afternoon on Market Domination, so don't miss that. Coming up, the next round of Yahoo Finance's Market Madness. You're watching Market Catalyst, and we'll bring you that next. Schwab is rolling out new teen investor accounts as of today. So let's talk more about that and more about the retail investing landscape in general. Jonathan Craig is joining me now. Charles Schwab, Managing Director and Head of Retail Investing. Thanks for being here, Jonathan.
Yeah, thank you for having me.
So talk to me about the teen investor account. I mean, is this the first time before now? Could teens have signed up for accounts, or is this just sort of a product that's more tailored for them?
Well, I'm really excited to launch or to announce the launch of this teen account. It really is a purpose-built account for 13 to 17-year-olds to get started investing early and hopefully on a path of lifelong investing success. The alternative up until now for most, including at Schwab, was a custodial account. And custodial accounts are very valuable as well. But in a custodial account for a child, the parent is very much in control. The parent sets up the account, the parent does the trading, the parent logs in. The child is very much a passenger. But in this teen account, the child has a lot of freedom to invest on their own. So we're really excited. As you can imagine, it has the appropriate guardrails, but I think it is very novel and unique to the category, and I think a great time to launch it.
And do you have any good insight up till now? How many kids had those types of custodial accounts? Like, talk to me about the demand for something like this.
Well, there is certainly high demand for custodial accounts, both at Schwab and we've seen it across the industry. But what we see and hear from parents and our clients, we have 27 million retail clients, and they have children, grandchildren, nieces, nephews, loved ones. They want those children to get started investing early. They want them to do it at a firm that will provide the service and support their loved ones need. But they also want the child to experience what it is to truly be an investor earlier in life. And so again, the big difference between what we're launching and the custodial account, the teen really is a passenger. And in this account, this is a joint account where the teen has their own login. They can trade, they can move money, they can truly experience the market. They can go through all the education on Schwab.com, and we built a whole set of education unique to this account. So it really is an account where the child is in control.
I guess for better and for worse, right? Because they could lose money, potentially through this.
Certainly, and investing, the best thing that probably one of the biggest assets anyone has in investing is time, and these folks have a lot of time if you're starting at 13. So there's certainly risk involved with investing, but when we built the account, we did it very purposeful, and we put in appropriate guardrails. So the teens can trade equities and ETFs, they can trade mutual funds, they can buy fixed income. We probably won't see a lot of that, but they can do that. But they can't use leverage, they can't use margin, no derivatives, no futures, no Forex, no options. So there's those guardrails. Also, it's important to know that the parent has to set up the account initially. So the parent sets up the account, and then the child goes in and establishes their own credentials, at which point both have credentials. It's a joint account, and the parent gets notifications and alerts on what's going on. So there's, I like to say that the child has a high degree of freedom, but the parent still has control.
I have to say, I have a couple teenagers, so this is definitely an interesting proposition for me. Schwab isn't the only company to have a sort of teen type of account. So how are you guys sort of trying to differentiate this one from some of the other offerings out there?
Well, I don't know if I won't speak to specific other competitors, but we believe this is unique in the industry. What most people are offering or what others are offering are custodial accounts. And again, it's a very different account type. And the custodial account serves a purpose, generally for long-term investing. It's meant to turn into an IRA and retirement investing for the child. This teen account is meant to be a functional brokerage account. In fact, teens can move money in and out of it. So if they have a job, I have children, they're beyond teenagers now, but when they had a job, had we had our teen account, they could be direct depositing into that account. They can withdraw via debit cards and other means. They can take pictures of checks and deposits. So it is an investing account, but it also serves as a cash management account for, even if your teenagers have a job. So it's very different than anything we've seen out there.
Gotcha. I want to, as the head of retail investing, I want to broaden it out a little bit because I saw some headlines from Vanda Research earlier in the week that we had seen the first day of net selling for retail investors. I think it was Monday of this week. And obviously it's a very turbulent time in markets, but I'm curious what you're seeing there on the Schwab platform.
Yeah, it depends a little bit on the horizon. We've seen record client engagement. Over the last 5 quarters, we've brought in over 1 million new accounts each quarter. We just put out our most recent monthly activity results, and we had record daily average trades, record margin, record client engagement in terms of login. So overall, we were seeing incredible client engagement. More recently, with the spike in the VIX, there's no doubt, that spike brings us back to a couple spikes last year. Seen a little bit of change in client behavior, some moving out of some of the oil stocks, some moving out of some of precious metals, moving in a little bit to buy the dips in AI. But overall, what we see and what we say is you need to have an investing plan or a trading plan, and you need to stick to that plan. And generally speaking, that's what we're seeing. So overall bullishness, but certainly some repositioning in the current market.
Yeah, I mean, it's interesting, sort of, I don't know, maybe a week and a half ago into this war in Iran, I talked to one strategist who said that maybe one of the reasons that stocks haven't fallen more is because of this sort of irrepressible, call it fear of missing out, call it buy the dip, whatever you want to call it, that was one of the support things that continues to support the market here, that people are worried if they do sell, maybe the conflict ends tomorrow and then stocks rally big and they'll have missed out on that. Would you agree that that's part of what's going on?
Well, I think successful investors and traders, and certainly at Schwab, have a plan, and within that plan, generally they're sticking to it, and inherent in that plan, they have risk management built in as well. So, and part of that is also understand the horizon around which they're investing. So I think certainly there could be support provided by the retail investor, but it would be born out of a broader view of what their trading or investing plan is and how this fits into it.
Jonathan, thanks so much for joining us. Appreciate it.
Thank you.
Yahoo Finance's Market Madness bracket is down to the Sweet 16. Heavyweights like Nvidia, Walmart, and Alphabet, they're still in the draw after last week's first round. So let's take a look at today's matchups on the right side of the bracket. And Burns McKinney, NFJ Investment Group Senior Portfolio Manager, is joining me now for Market Madness, brought to you by Everpure. Thanks so much for being here. Appreciate it.
No, thanks for having me. The only thing I like better than stock picking is probably March Madness. So
okay, we're bringing it all together for you, Burns. Okay, so let's get right to it and talk about some of these matchups and what you think here. So first up, we got this is a tough one, I think. J.P. Morgan Chase versus Netflix. Which of these do you like better?
This might be a bit of an upset, but yeah, I look at J.P. Morgan and you've got it for 13 times earnings. That's about a 40% discount to the market. That's double their typical discount. They have a dividend that's twice that of the market, and they've tripled that payout over the past decade. 17% return on equity. That really suggests that it deserves a higher valuation. And they've demonstrated through prior crises, whether it was the pandemic, whether it was the global financial crisis, that they have the best management team of the big banks. They've been investing in improving technologies, and as a result, they've been taking share in just about every business, and they benefit from deregulation. And on the flip side of that, if you look at a Netflix, the stock surged after they called off their Paramount bid, but at this point, really the catalyst is removed, and they have solid subscriber base, but that growth is slowing a little bit. So we're going to go with JP Morgan.
Yeah, and it's interesting. I mean, Netflix is down 4% over the past year still, even with that post-deal fall apart surge. But I guess it's all relative, right?
For sure.
Yeah. All right, let's talk about the next one here. This is another interesting one. Amazon versus Delta here. You're like an Amazon. This one seems like a more clear-cut one to me, personally.
Not exactly the upset. Amazon is a name. You get Amazon right now for roughly 25 times earnings. Their premium to the overall market is the narrowest it has ever been. Right now, if you look over the past decade, it's only been this cheap on a relative basis about 1% of the time. And you're not paying up for growth. Earnings are forecast to grow by 27% per year over the next 5 years. So if you think in terms of the PE to growth ratio, or a PEG ratio, that's less than 1. It's about 0.9, which is half that of the broader market. And you're looking at a business for which they have an unparalleled fulfillment and distribution network, which really creates a competitive moat. And they really just finished spending a ton of money updating that. So as a result, now that they're done with that, they have a lot of free cash flow they can distribute. And given that there's nearly no net debt on the balance sheet, a lot of that may go to shareholders in terms of repurchases. And of course, you have the crown jewel, the AWS, the cloud business is really one of the best ways in the market to play rising demand for digital content, for AI. And on the flip side of that, Delta, admittedly, among the legacy carriers, they probably have the best management team, but at the end of the day, it is an airline. You have to get your timing just right in the airlines. They're capital intensive. It's highly competitive. There's that old saying that flyers will sometimes they'd be willing to buy a ticket on a plane with one wing if it might save them $10. So you really don't have a lot of pricing power there.
Yeah, and I mean now in particular, as someone who traveled out of Houston or out of the Houston, Texas area recently, I don't know if you've flown recently, Burns, but it has not been fun lately. And of course, then you put fuel costs on top of it. I'm curious, is there any time that you invest in airlines, or is it generally something you avoid?
You need to not think of them as really long-term investments, but every now and then you do get the valuation low enough that you might actually make a trade in those. But there again, Warren Buffett used to say the best way to make $100 in an airline is start off with $1 million.
Right.
So you need to get your timing just right.
All right, let's get to the next one. I might consider this a little bit of an upset also. We've got McDonald's versus NVIDIA, and you picked McDonald's.
Yeah, you might call this that proverbial 12-5 upset. In the case of Peter Lynch used to say, invest in what you know. And just this morning, I noticed a McDonald's delivery of coffee on our front doorstep. My son goes there after school. I get breakfast there a lot. So the McKinney family celebrates all things McDonald's, but it's trading in line with the market. They've raised the dividend payout every single year for over 4 decades. They've been very generous to shareholders. NVIDIA, obviously they have some of the strongest fundamentals in the market, but I think what you have to consider is in stock investing, it's not necessarily how good the fundamentals are, but how good they are relative to what is already priced in. And given the strong rally, the bar's been set pretty high.
Have you tried the Big Arch yet?
You know what? I've been tempted by the commercials. I'm absolutely meaning to. I'm more a McDonald's breakfast sandwich guy.
Got it. Copy that. All right. And then finally, we have Coinbase versus Nike here. I don't know, you obviously are a McDonald's household. I don't know if you're a Nike household and how that factored into your decision.
I've been very loyal to Nike running shoes for years. I love the brand, but at the same time, they are in the midst of a turnaround, and we're still in a bit of a wait and see mode on that. It might not necessarily rally prior to that. In the case of Coinbase, you really have one of the top brands, largest crypto exchanges. It's really, they have some of the most stringent and the best regulatory and compliance, which makes them one of the most trusted names there. And so for investors that are really just trying to get broad diversification and get exposure to crypto, this might be a low capital intensity, lower risk way to get that exposure. So we're going with Coinbase here.
Do you worry at all that they're too tethered to the fate of the cryptocurrencies themselves and to Bitcoin especially?
It's absolutely one of the risks, but at the same time, it's a little bit of a lower leverage way. So rather than necessarily make a big bet, you're making a smaller bet, and really it just represents a little bit of diversification to any broadly diversified portfolio.
Yeah, I mean, it's true. Of course, Bitcoin's down a bunch over the last year, but Coinbase is down less, much less, in fact. All right, Burns, thank you so much. Really appreciate you joining us for our market madness. And stay tuned to Yahoo Finance. We're going to discuss the other half of the bracket. That'll be Friday on Market Domination. And that does it for Market Catalyst. I'm Julie Hyman. Thanks a lot for watching. We got more Yahoo Finance coming up.